Hey everyone, welcome back. We're diving into dividend investing today and whether a well-established company, we're talking Lockheed Martin here, can really deliver those monster returns that get investors so excited.
Always a hot topic.
It really is, and our sources, they seem a little skeptical, so let's see what we've got.
Yeah, let's unpack it.
So right off the bat, the idea that dividend growth really hinges on earnings growth, right? And they use Lockheed as a prime example, emphasizing how important that steady growing cash flow is, not just to pay dividends, but to keep increasing them. And they keep coming back to this metric, free cash flow per share. I'll admit, I kind of glossed over it at first.
Yeah, it's easy to get lost in the jargon sometimes. But free cash flow, honestly, it's pretty simple. Think of it like this. It's a company's financial wiggle room. The cash they've got left over after covering all the essentials, the bills, the investments, and that leftover cash, that's what fuels those dividend payments we all love. If a company's got weak free cash flow, well, they're going to struggle to pay those dividends consistently, let alone increase them year after year. And that's what we want, right?
Absolutely. Consistent growth is key.
Yeah.
And get this, the source points out that Lockheed's cash flow growth, it's actually been outpacing its dividend growth. At first I thought, why not just give all that extra cash back to investors? But then it clicked why that's actually a really good sign.
Exactly. That gap there, that's a huge signal. It shows they've got flexibility. Lockheed could increase those dividends even if growth slows down, even during a downturn, and that's got to be reassuring for long-term investors.
It's like they're playing it smart, not overextending, right?
Exactly.
And the source even gives some concrete numbers. Over the past 10 years, get this, Lockheed Martin's free cash flow per share up a whopping 204%.
Wow.
Their dividend per share grew too, but only 127%. So there's that gap we're talking about, fiscal responsibility, but with room to grow those payouts.
That's what gets dividend investors excited, that consistent, responsible growth. It's a marathon, not a sprint.
Okay, so we've got this foundation of solid earnings, cash flow's looking good, but here's where it gets even more interesting, and this is where the source really dives into share repurchases. They argue it's not just about the dividend itself, it's about how many shares are out there. Can you break that down for us?
Absolutely. Think of it like a pie, right? The company's profits, that's the pie. Every time they buy back shares, they're slicing that same pie into fewer and fewer pieces. So each slice, each share, represents a bigger chunk of those profits, which means, for you as the investor, a potentially larger dividend payout per share, even if the total amount stays the same.
Oh, interesting. So it's kind of like a hidden bonus?
Exactly. A subtle but powerful way to boost those returns over time.
I like it. And Lockheed Martin, they've been active with these buybacks. The source says they've shrunk their share count by a quarter over the past decade. That's 25% fewer shares.
Wow. So for anyone who's been holding on to the stock, those dividend payouts are looking better and better.
Yeah, exactly. Compounding those gains.
But that's where the magic happens, long-term investing.
So we've got this picture of good cash flow growth, solid dividend history, and the share buyback program quietly boosting those payouts. All sounds pretty good, right? But here's where I got a little stuck. Lockheed Martin's current dividend yield, it's just 2.1%. Doesn't exactly scream retire early,
It doesn't, no, and that's a really important point. With dividend investing, we're thinking long-term. 2.1% might not turn heads at first, but the key here is consistency, and as we've been saying, that growth over time, that steady income plus the power of compounding, that's what can lead to serious returns down the line.
Yeah, I get that, but I see headlines, some tech stock going through the roof overnight. It's tough not to feel that little pang of, what if I'm missing out?
I hear you. But remember, high growth often comes with high volatility, right? Those flashy tech stocks can disappear just as fast as they pop up. With Lockheed Martin, it's a different story. It's stability, predictability, a history of delivering for investors even when the market's a roller coaster.
So it's more like a marathon, not a sprint.
Exactly. And Lockheed Martin's really well positioned for that long game. The source really highlights this. Those deep roots in government contracts, that brings a level of predictability you just don't see often in the stock market. I mean, think about it. Governments, they're not exactly known for suddenly slashing defense spending, even in tough times.
In fact, they often ramp it up, right?
Exactly. So while Lockheed's not totally immune to economic ups and downs, those government contracts, they're like an anchor, a steady stream of business that's really appealing to dividend investors.
Yeah, that makes sense. But our source did start off questioning if Lockheed could really deliver those monster returns people chase. And they brought up this fascinating example in NVIDIA, the tech giant.
Oh yes, NVIDIA, a classic example of what happens when you get in early on a true innovator.
Right. And they said, imagine you'd put just $1,000 into NVIDIA back in 2005. That investment would be worth over $800,000 today. I don't know about you, but that's hard to ignore.
It's incredible growth, for sure. But you have to remember, past performance and all that, it's not a crystal ball.
Of course, yeah.
But the NVIDIA story, it highlights the potential that's out there, the power of finding those right companies, especially in tech, where things move so fast. So how do we square that with this idea of slow and steady dividend growth with Lockheed? It's a great question.
So we've got these two contrasting examples, NVIDIA, exploding growth, and Lockheed Martin, the steady dividend payer. Makes you wonder, can a company like Lockheed, with its more predictable path, really compete with that kind of wealth-building potential?
That's the million-dollar question, isn't it? And honestly, it's one each investor has to answer for themselves. Risk tolerance, time horizon, goals, it all factors in.
No magic formula, huh?
Nope, not one I found at least. The NVIDIA story, it's compelling, but you gotta remember, for every NVIDIA, there are tons of companies that didn't quite hit those heights. Early stage growth, inherently risky.
Yeah, that makes sense. So where does that leave us with Lockheed Martin? We've got this company, deep ties to government contracts, a history of consistent dividends, that buyback program quietly working in the background. Maybe not as flashy as some tech darling, but could this be that slow and steady wins the race scenario?
That's the question, right? And based on what we've seen, there's a strong case to be made for Lockheed Martin. A lot of the hallmarks are their financial stability, commitment to shareholders, business model that's somewhat sheltered from those big economic storms.
But like with any investment, I imagine there are risks, uncertainties.
Always. Political winds can shift, budgets get cut, new technologies pop up and disrupt everything. No guarantees in investing, that's for sure.
So for our listener, what's the takeaway? What should they be chewing on as they decide whether to add Lockheed Martin to their portfolio?
Focus on the long game. That's key. Don't get distracted by chasing those quick wins or trying to time the market perfectly. Look for companies that have a track record, that are committed to dividend growth, and most importantly, companies with a business model you understand and believe in.
I love that. It's about making those informed decisions, sticking to your strategy.
Exactly. And remember, we've just scratched the surface here. Always more to uncover, more to learn.
Absolutely. Always do your own research, folks. Dig deeper. Go beyond the headlines. Truly understand the companies you're investing in. What we've done today, it's a starting point, a framework for thinking about dividend investing, using Lockheed Martin as our example.
A springboard for your own deep dive, so to speak.
I like that. A deep dive within a deep dive. Well, on that note, we've reached the end of our exploration of Lockheed Martin and the world of dividend investing.
It's been a pleasure diving in with you.
Likewise. And to our listener, thank you for joining us. Hope we've sparked your curiosity and given you some food for thought as you navigate the world of investing. Until next time, happy investing.